Well, whether it's ever going to officially wave that flag or the markets are going to have to figure it out just based on what the Fed is doing rather than what it's saying. But you're going to looking at the foreign exchange market, watch what happens to the dollar. If I'm right, if we really start to break down on the dollar, if gold takes off, gold's been hanging out around 2,000. It hasn't been able to really break above it. I think when we decisively move above 2,000, maybe 2,100, we hit a record high. Gold will probably never trade below 2,000 again.
Peter Schiff paints a vivid picture of the impending dynamics in the markets. He suggests that a potential breakdown in the dollar, coupled with a decisive move in gold prices above 2,000, possibly reaching 2,100, could signal a record high. According to Schiff, this surge in gold is not just a market trend, but a warning sign of a crisis in confidence in the Federal Reserve, the dollar, and the Treasury market. As gold prices climb towards 3,000, Schiff anticipates a domino effect, with long-term interest rates rising and the economy reacting. He predicts a scenario where the Fed, faced with economic challenges and an election year, will resort to stimulus measures, effectively embracing inflation. Schiff contends that quantitative easing is synonymous with inflation and expects the markets to react accordingly, leading to a potential collapse in the currency and a breakout of inflation. Despite the current gold price lingering around $2,000, Schiff sees this as a temporary phase and encourages viewers to consider it a favorable buying opportunity. He suggests that once gold decisively breaks out of its current range, possibly above 2,100, buyers waiting on the sidelines will enter the market, driving significant gains.
And we'll have a solid base of support. And when the gold price really starts to get closer to 3,000 and 2,000, which you can do very quickly, that's really, a warning sign to the world that, we're out of room here. That there is a crisis of confidence in the Fed, in the dollar, in the Treasury market. And we start to see the long end of the curve really starting to get hit. 30-year Treasuries are now back below 5%. They're like 4.85 or something. But the curve is now normalizing somewhat because the yield on the 30-year didn't go down nearly as much today as on the 10-year or as the 5-year. But when we really start to see the yields blowing out because rates are going a lot higher, that's when it's going to hit the fan because now the economy is going to start reacting to this big backup in rates. The commodity prices are going to start reacting. Oil prices are going to react to the weak dollar. All that's going to obviously start showing up in CPI. So you're going to start to see these inflation numbers moving up as the economy is weakening. We're going to start to see a big uptick in unemployment. And, the Fed is going to have to choose. And I think publicly, especially it's an election year next year. And if unemployment is rising and the economy is weakening, the Fed is going to go for stimulus. Well, stimulus is inflation. That's all stimulus ever was. Mm-hmm. That's the only arrow in their quiver is inflation. That's what quantitative easing is. It's inflation. It's a euphemism for inflation. And they're going to go back to that. They're going to abandon quantitative tightening. They're going to go back to quantitative easing, even as inflation is well north of 2% and rising. And then the markets will figure this out, and then the currency will collapse, and inflation is really going to break out. And then the Fed is going to have to decide, is it going to do anything to rein that in or just allow, hyperinflation? I think it's putting in a bottom here. I think the dollar is put in a top. I think that if you can buy gold below 2,000, I think you're getting a great price because, once it puts a little bit of distance between itself and 2,000. So let's say 2,100. Mm-hmm. I don't think you'll ever see it below 2,000 again. I think it's just like, now we need to get above 2,100. Let's say we need to decisively break out of this range so that the resistance is gone. And then I think a lot of money is going to move into gold. I mean, right now people are thinking, well, why buy gold? It can't get through 2,000. I mean, there's not a lot of upside. So the buyers are waiting for a break. They want to buy 1,850 or 1,900. So they're patient, they're waiting. But I think once we really break out, they're not going to wait. They're going to stop waiting and start buying.
In this next discussion, Peter Schiff expresses grave concerns about the mounting U.S. debt. He highlights the global dependence on the dollar and stresses the need for other nations to trust in the stability of the U.S. currency. Schiff warns of potential consequences if inflation spirals out of control, leading to diminished faith in the dollar. He envisions trading partners losing interest in holding U.S. dollars in debt, painting a scenario where the exchange rate collapses, making imports unaffordable. This, coupled with the service sector-dependent U.S. economy, could face a catastrophic collapse. Shifting to the staggering national debt, Schiff emphasizes its colossal scale, surpassing that of all other nations combined. He predicts the challenges of servicing this debt, especially as interest payments soar. Schiff concludes with a grim outlook, suggesting that interest on the debt might consume the entirety of tax revenue, ultimately leading to an unsustainable situation and a potential economic collapse. This analysis serves as a stark warning about the pressing need to address the growing U.S. debt crisis.
Well, because we use our dollars to pay for all the goods that we don't produce. And so the world needs to want our dollars. And not just our dollars, they have to want our debt. They have to want our treasuries. Because when all these countries that are running trade surpluses with the United States, they earn all these dollars, what do they do with them? They buy treasuries. So they have to want to own our debt. They have to want those treasuries. They have to want those dollars. But they only want dollars if they're confident in the future purchasing power of those dollars. They have to believe that the Fed is serious about maintaining the purchasing power of the dollar and keeping inflation low. But once our creditors recognize that inflation is out of control and that the Fed is no longer trying to rein it in, it's more concerned about propping up the economy, propping up the government so it can keep on spending, then our trading partners are not going to want those dollars anymore. And we have a real problem because now the value, the exchange rate, is going to collapse. And then we can't afford to import all of those goods that we were previously importing. Well, how is our economy going to function without those goods? Because we don't have a domestic source of those goods. And we've built this entire service sector economy on the foundation of imports. Because if you don't have the products, then most of the services don't have much value either. So you take away the products and everything that's been built on top just implodes. So our entire GDP just collapses. Meanwhile, we owe the world a fortune. We're the world's biggest debtor nation. We have more debt than all the other nations combined as far as what we owe. And how are we going to service that debt? It becomes more and more expensive, a bigger drain on the economy. I mean, look at just the interest on the national debt. I mean, at the end of this year, interest on the debt is going to be a larger expense than defense.
Yeah.
About trillion.
360 billion.
But by the end of next year, it could be the biggest. It could be more than Medicare or Social Security. Over the next 3 years, half the debt matures. So that's 34 trillion. Half of that is 17 trillion. We have to go out and borrow that 17 trillion to repay the maturing bondholders because they may not want to roll those bonds over. We've got to borrow that money. Over the next 3 years, I'm sure at a minimum, we're going to add another 10 trillion to the national debt, at a minimum, probably more. So that means we have to borrow $27 trillion. At what rate of interest? And what is that going to cost? Because even if we have to pay 5% interest on that money, that alone, just that 27 trillion, is close to 2 billion, or 1.75 trillion rather, in annual interest. Annual. And that doesn't even count the interest that we're paying on the other debt. So if we're paying $2 trillion a year in interest on the debt, that's about 50% or 45% of our current tax revenue. But in a recession, our tax revenue is going to go down. So maybe interest on the debt will be more than half our tax revenue. And if this continues for a couple more years, interest on the debt will consume 100% of our tax revenue. And everything the government wants to spend money on, 100%, will have to be borrowed, which is impossible. There's no way we can make it without a complete collapse, which is why it's going to happen.
Thank you for joining us as Peter Schiff unraveled the complexities of the current economic landscape. Schiff's insights into gold prices, the U.S. debt, and the dynamics of the global financial system shed light on potential crises on the horizon. His warnings about a weakening economy, rising unemployment, and the Federal Reserve's reliance on stimulus measures provide crucial insights. Additionally, the discussion on the mounting national debt underscores the urgency of addressing these challenges to avoid potential consequences, such as a collapsing exchange rate. Stay tuned for more discussions, and don't forget to subscribe and hit the notification bell for further insights.